In this video, we'll explain Doji candles. Doji candles are simple but powerful. They represent indecision in the market. Let's understand what that means. A doji forms when the open and close prices are very close. This creates a small body. Sometimes it looks like a cross or plus sign. It shows buyers and sellers are balanced. Neither side has full control. Doji candles often appear before reversals, but not always. Context is very important. If a doji forms after a strong uptrend, it may signal weakening momentum. If it forms after a strong downtrend, it may suggest selling pressure is slowing. There are different types of doji candles. Some have long upper shadows. Some have long lower shadows. These shadows show rejection of price levels. But remember this clearly. A doji alone is not a trading signal. It must be combined with support or resistance, and with overall market structure. Beginners often enter trades immediately after seeing a doji. That can lead to mistakes. Wait for confirmation from the next candle. Patience improves decision-making. Think of a doji as a warning sign. It tells you the market is pausing and possibly preparing for a move. Always analyze the bigger picture. Use higher time frames for clarity. Combine structure with price action. Quick recap. Doji candles show market indecision. They can signal potential reversals, but they require context and confirmation. Use them wisely, not emotionally. In the next video, we'll cover hammer and shooting star.